Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the Monday edition of The Real Investment Show. It's May the 5th, getting the new month getting the new month started. It's also the end of the school year. Everybody's getting ready to graduate. My daughter, 18, she's graduating this year, yes. And so I've got prom, I've got graduation party, I've got graduation. I just want this month over with.
But then she's off the payroll.
She's off the payroll, going to Baylor. Done. So also had my last child support payment on Monday.
Hey, congratulations.
Exactly, financially free.
It's like getting a raise.
No doubt. No doubt. So it's all good stuff, month of May. It's also my birthday this month, so there's that, the big 60.
Mm-hmm.
Yeah. So
you don't look a day over 59.
I know you're like 55, so you don't understand what it's like being this old. So
I'm actually only 10 in dog years.
Exactly. That's right. I don't know how they figured that out.
I don't know. My dog's not amused.
Exactly. So anyway, lots of stuff to get into, of course, today. It is the start of a new month. Stock buybacks have now come back. The window is now open for share buybacks. Of course, that's been a big support for this rally over the last couple of weeks. We've had a 10% surge in buybacks just over the last week. So again, that's been a big support, big driver here. So those buybacks will continue through May. And then, of course, as we start to get into June, we'll start to close that window back up again for the next reporting season. So yeah, it's going to happen quick, right? So, but that is providing us support. So again, that's doing well. Earnings season has been good so far. And what's interesting about earnings season, of course, this is first quarter. And this is before tariffs and before everything else that was going on. So earnings season was okay. We lowered guidance pretty substantially, so they were able to beat earnings. So we had a lot of earnings beats, about normal. Estimates right now, of course, are running at about 12%. That's come down from where they were. It was about 19. It's come down to 12. That'll probably get lowered a little bit more here as we go along. But overall, earnings season was okay. We still have a few laggards that are out there. NVIDIA has yet to report yet. There's a Palantir reports today. So we've got a few kind of more notable companies still yet to report. But for the most part, about 74% of all S&P 500 companies have now reported. So we've got a pretty good feel of what earnings season was, and it wasn't bad. There's really no sign of economic recession or anything on the horizon. It wasn't a bad earnings season. So but guidance was a little bit hit and miss. And again, a lot of uncertainty, of course, with guidance because of what's going on with tariffs and all that type of stuff. But it was a bit hit and miss on guidance. And so overall, again, it was an okay earnings season. It wasn't bad. That did help give some support to the markets as we kind of expected. We written on April the 7th. We published an article very early in the morning on April the 7th and talking about how the market decline was likely over and we get a reflexive rally at that point. Of course, April the 7th was the low for this Liberation Day type sell-off in the market. And since then, we've had a decent rally. And the target that we set out in that report was about 5,700. We closed at 5,686 on Friday. So right there at the target. As we've talked about before, we've had a decent rally here. So again, there's going to be a lot of trap longs in here that are looking for an exit. But again, overall, the market's doing just fine. Really not much to worry about here. The employment report on Friday, 177,000 jobs, stronger than expected by a large degree. A lot of people were expecting a really weak jobs report. That didn't happen. But employment is slowing down. We are seeing a slower growth rate in employment as the economy slows down. Wages are declining. Wage growth is, I shouldn't say wages are declining, but the rate of wage growth is declining. So that's all going to feed into slower economic growth going forward. So the economic slowdown is still very much intact here. And that's not changing, but it's not recessionary. And again, there's been a lot of talk lately about, recessions coming, recessions here because of tariffs. And there's really no evidence of that at this point. Now, could we have a recession in the future? Sure, absolutely. Right? I mean, we will have a recession some point in the future. We will have a recession. But right now, the economic data does not point towards a recession. So again, this is giving a little bit of relief to markets. But as we talked about before, this is time to kind of pay attention to portfolios. So let's talk a little bit about the markets here. Here's what you need to know before the bell. Today's article on the website is called "Resistance is Futile." I've been on a Star Trek binge lately. I did Spock, Spock's Rules of Investing last week. So we're talking about "Resistance is Futile" today, which was a line from Star Trek when they were fighting the Borg. Anyway, that article is on the website this morning. But resistance is important because it applies to both the upside and the downside in the markets. And this is where we often kind of get distracted by markets when markets are going through a decline like we were. Of course, we had Liberation Day. We had this very sharp sell-off in the markets. And that was why on April the 7th, we wrote that article. It's like, hey, we're probably going to find a bottom here and markets are going to start to rally. And that was because we had hit resistance on the downside, right? We call it support, but it's the same thing. It's resistance to prices going lower, just like you have resistance on the upside of prices going higher. So we had this very, very sharp decline. We got more than 3 standard deviations below the 50-day moving average. When you have that kind of deep sell-off, you're going to have buyers come back in the markets. Basically, you exhaust sellers, and then buyers can step in. It doesn't take a lot of buying to start moving prices higher, and as prices start to move higher, that then elicits the chase of stocks going back up. It's like, oh my gosh, I'm missing out. I sold the bottom. I got to get back in. That's exactly what's been happening. Now, we had 9 straight days of an advance. That is the longest stretch of an advance, consecutive days being up in 21 years. So we haven't had a stretch like that since 2004. Now, here's what the important part about this. All records are meant to be broken, right? So again, you have a record of anything, right? You have Usain Bolt, right? He was the fastest sprinter in the world in history, right? There'll be somebody that actually outsprints him at some point, right? There'll be somebody that can break that record. The problem with records is that is where the peak or the maximum attainment of any issue was done. Typically, once you reach that level, then it's very hard to just keep beating that record over and over again. So it's the same thing in the financial markets, is that when you have these very long stretches, a record was where the market peaked the last time that happened. So the last time that we had 9 straight days of an advance was back in 2004, and then that was it. And it took 21 years to repeat that process again. So what we need to be paying attention to here is that markets have now rallied back to above the 50-day moving average. That's good news, right? So that's bullish. But sitting right above this is the 200-day moving average, and now you've had this very long streak. The number of stocks that are above their 50-day moving average is now back to 90%-ish. Normally, when you get a very high ratio of stocks trading bullishly, that typically tends to be the peak of a rally. So as we talked about in that article on April the 7th, and we talked about in the article today, this is a really good time here. If you didn't like that decline, and you were really getting pressured into needing to do something, and we kind of warned you, like, be careful when you feel like you have to do something, just wait. Now's the time to start doing something, right? So this is where you want to rebalance risk, look at your portfolio, add a hedge, whatever it is, because very likely we're going to have some level of retracement here. We're going to have some type of corrective action. That doesn't mean necessarily that markets are going back down to their lows. I'm not saying that at all. But you could come back down here, retest the 50-day moving average, retest this kind of support level that we had going back just, as we had that Liberation Day announcement. There's the potential here for stocks to pull back here a bit, work off some of this overbought condition, give you a better opportunity to rebalance your position, add some equity exposure at cheaper prices. But you can't do that if you don't rebalance your risk here and take some profits. So again, I would really urge you to kind of look at your portfolio, look at things that have gotten really overbought here short term, rebalance that risk, look to add a hedge to your portfolio, whatever it is, because we're going to have some type of give back of this rally. How big that give back will be, I don't know, but it's going to happen. But that's what you need to know before the bell this morning. We'll come back. We'll talk a little bit more about why resistance is futile. and then also some other stuff we got to get into today as well. So don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So over the weekend, Warren Buffett had his annual Omaha gathering where everybody flew up for the annual Berkshire Hathaway meeting. And during that meeting, he made a surprise announcement that he is now stepping down after 6 decades as being CEO of Berkshire Hathaway. And of course, Greg Abel, who has been being groomed for that position for the last decade, was unaware that this announcement was coming, by the way. But Greg Abel is now stepping in to take over for Berkshire Hathaway. So it'll be interesting to see how the stock responds this morning to that news. But caught a lot of people by surprise. They weren't expecting it at this meeting. But, he says, hey, it's time. And it is time. Warren Buffett is not a spring chicken anymore. He is almost as old as I am. But anyway, just a phenomenal career. Again, from a guy that took literally a textile company back in the 60s and converted it into an excess of a $1 trillion market cap conglomerate. That's quite the story. So, of course, he's been, widely regarded as, an investing legend, and he should be noted as that. And what's been interesting, though, most interesting to note about Warren Buffett is that I remember back in the kind of mid-90s, 95, 96, 97, Warren Buffett didn't own any technology stocks. And, people are like say, oh, you're missing out. Right, of course, we're having this big .com boom then. And back then, headlines were being written as that if you're investing with Warren Buffett, it's like driving Dad's old Pontiac. And, of course, took about 3 years. And he was proven right, of course. And, of course, the .com crash came along. And, he survived Berkshire Hathaway and his value investing mantras have survived bulls and bear markets. And whenever people, and kind of a good contrarian indicator is when anybody starts poo-pooing Warren Buffett about his investing style, it was generally a good time to go be a Warren Buffett investor because, 2008 came along and people had once again started kind of doubting his veracity as an investor. And of course, 2008, he stepped in and was lending money to Goldman Sachs and other, bailing people out, making just a ton of money for his investors on top of it. So, it's quite fascinating stories, and I've followed Warren Buffett for decades and have watched him, navigate markets. I've learned a lot from him, just from watching how he manages his portfolio, and a lot of the same things we incorporate in ours. But it's quite a fascinating history of watching all the ebbs and flows that he navigated, and the times that he's been discounted, and the times that people have kind of questioned his investing ability at certain times when we're in these little phases of market bubbles, and everybody's all excited about things. And of course, he's sitting back going, "Yeah, no, I'm not gonna buy into that." He's been paid multiple times. And of course, right now the big story is he's got about $380 billion in cash. What's he expecting? And he's not really expecting anything. He's just saying, hey, look, right now I don't have a better use for my cash, so I buy T-bills. And there's nothing wrong with that. But, again, the media wants to try to make a story out of it. He's expecting a crash, whatever it is. No, he's just investing. And he did say, rightly so, is that I want to have cash. If something happens, I want to have cash. And this is a mistake that a lot of investors make, is that they feel like, and of course, this is because Wall Street tells you this, is that if you're not fully invested all the time, you're missing out. And, we often forget that the whole point of investing is to buy stuff when it's cheap, right? But I can't buy stuff if it's cheap if I don't have any cash. So if I'm fully invested all the time, and this is why, just like a minute ago, I was talking about take some profits, raise some cash, because markets have had a decent run here. But if you don't do that, if you don't raise some cash, then when markets pull back, you don't have any cash to buy anything with. So, this whole idea of being invested all the time, it's great for Wall Street because they get to charge you a fee on invested assets, but it's not really all that great for you as an investor because it gives you no options. And again, remember, cash provides you optionality because I have the option to do something else with it, and I can take advantage of opportunities that exist from time to time. But I can't do it if I don't have cash. That's why, right now we're carrying extra cash in our portfolios. We've got a short position against the markets at the moment just to hedge some risk. But we're waiting for a pullback because there's stocks we want to buy. Let me give you a good example. Apple. Right? So I flew to New York on Friday, and that was a whole adventure in itself, to do an interview on Fox Business. And it was interesting because Apple was down on Friday because of their earnings. And they're taking a $900 billion charge, and this is why the stock was down, because of tariffs and those type of things that are going on in the markets. And, if you think about that, $900 billion, this company prints billions of dollars every quarter, right? $900 million is a rounding error for Apple, but yet the stock's down 3%. So there's that provides you an option. And I'm not saying go buy Apple this morning. I'm not saying at all. But, those types of reactions to markets when they occur because of some piece of news gives you an option to go buy that stock cheaper. So if you want to buy Apple, there is a better opportunity right now to own Apple in your portfolio than there was on Thursday, right? Just because of that. But you can't do that. And this is Warren Buffett's kind of whole method of managing portfolios is that, I'm looking to buy things that are undervalued, and I want to buy things that are cheaper relative than the markets. And that's what he does. He looks for these really, kind of outstanding opportunities. When Goldman Sachs was on the verge of bankruptcy, it's like, yeah, I'll loan you money and you're going to give me a 10% warrant and we're all going to make money together. And they did, right? But that's the goal. But you can't do that if you're fully invested all the time. And having cash gives you some opportunity. But again, the mistake that we make is like, oh my gosh, I've got this cash sitting over here and it's not making me any money. That's okay. Now, don't get me wrong. Holding cash for 20 years is not a great idea, right? And I'm not saying that you should always have just a bunch of cash in the bank, right? I'm not saying that. You should have an emergency fund. You should have that. I don't care. Then that should just be invested in a money market account. That's if something goes wrong, your washer goes out, whatever it is, you don't have to sell something else. So you should always have an emergency fund to keep your lifestyle going. But I'm talking about investing cash. If you're sitting on cash in your portfolio for years, that's not a great idea because you're going to underperform inflation and you're going to miss out on opportunities. But holding cash for 3 months or 6 months or 9 months or even a year, that's okay. If you're waiting for an opportunity to buy something substantially cheaper, because it's going to happen. Markets are going to ebb and flow at some point. But again, Wall Street doesn't want you to hold cash because they can't charge you a fee on cash. So they're telling you, like, oh, well, you're missing out. You've got to be invested. But what that forces you to do is buy stuff that's overvalued, and then you wind up selling it when you have these type of corrections like we just had, in the month of April. You wind up panic selling it at a loss. And this is why investors often, buy high and sell low rather than, and again, the whole premise of investing is buy low and sell high, but we can't do that because we don't have any cash. And importantly, just like we had in April, on April the 7th, when we were writing the article about why that was probably the bottom of the market, nobody wanted to buy anything. But that's when you should be buying. That's where you've got to go against that internal emotion of fear and panic and loss avoidance and go, okay, I got to step in and start buying something. And, and we took a lot of grief when we started buying around April the 7th in our portfolios. We took a lot of grief for that. And then 2 days later, we had this huge rally. So, this is the thing that you've got to look at and pay attention to is, understanding the value of actually investing and not speculating in the markets. And we just wrote an article. If you haven't read it yet, it's on the website, realinvestmentadvice.com. It's on our Substack page as well. But we talked about the difference between investing and speculating. And, and there is a big difference. And if you're just chasing markets, you're just chasing whatever's hot, whatever's going up, there's nothing wrong with speculating. Don't get me wrong, right? There's nothing wrong with speculating, but speculating or trading is fine as long as you have a very structured way of doing it. And most people who are speculating in markets or trying to trade markets on a very short-term basis, they don't have a well-defined strategy. They don't have a discipline behind that. So they're just chasing anything that's going up, and then it eventually blows up and they lose a lot of money. We talked about this the other day, is that there's very few people that survive long-term trading. There's few people that do, but very few people survive long-term trading markets because eventually the market reverts on them and they wind up getting financially devastated during the downturn. Too much leverage, too much risk, whatever it is, that happens. But if you're investing, which is a longer-term outlook, focus on what's important, which is buying things that are undervalued and be willing to hold them through turbulent periods because of the long-term outlook for them. And that's Warren Buffett, right? He buys stuff for 100 years. He's not going to live for 100 years, but Berkshire Hathaway will live for 100 years. So he can buy stuff today in Berkshire and say, look, I'm going to own this for 100 years. He won't be around, but Berkshire Hathaway will. And that value that he buys today, it may not pay today, but it will pay over the long term. All right, be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Talk about, well, why do you own gold? Well, I own gold because if everything collapses, it won't matter anyway. You're not going to survive more than 7 days. I don't care if you've got gold or not.
The Real Investment Show podcast.
You don't know how to go out and forage for food. You don't know how to go out and hunt. You've been sitting around your house watching television with your feet propped up, drinking beer for 12 years.
Same show, your schedule.
Danny Ratliff is one. He's going to survive just fine. He's in South Africa right now. He's out there with a knife and Rambo paint on and stalking predatory animals. He'll survive just fine. My next door neighbor with the drill, he ain't gonna make it. No chance.
At realinvestmentadvice.com.
If economic Armageddon happens, pack it up, buddy. You're done.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So I was talking a little bit earlier a bit about the employment report on Friday, and it was expected to be pretty weak, and you saw the ADP report. It was fairly weak. I think it was like 69,000. Jobless claims though remain really low at this point, and it was interesting that just prior to tariffs being announced on Liberation Day, the average Wall Street bank was talking about a 20% chance of recession-ish, depending which one it was. Some were like 35%, some were 20%, whatever. So chance of recession was 20 to 35%. Well, as soon as tariffs were announced on Liberation Day, all those Wall Street banks came out and said, oh, recession's almost assured now. As of Friday, after the employment report and after a series of other economic data has come out, that's all been a lot stronger than expected. Odds of recession are back down to 20 to 30%, right? So in a month, Wall Street has turned from no recession to no recession again. And this is the problem, is that, again, we were just talking about investing a second ago, is you got to be careful of these headlines and these narratives, because a lot of it is just for attention grabs, whatever it is, and doesn't really have any value in terms of your investing. And this is why we talk so much about psychology. We talked about behavior, all those type of things. Trying to go against that inherent behavior is the hard part. And again, this is, I've kind of been on the Star Trek kick over the last couple of weeks. I wrote a newsletter 2 weeks ago talking about the investing rules from Spock. Just basically being unemotional about your investing. And it's a hard thing to do, to be unemotional when it's your money. It's your hard-earned money. But, this is, and I can always tell when we're in the middle of a correction. I can always tell from the emails I get from people that we're probably close to a low. Because again, I'll start getting a lot of emails about, oh, I'm losing all this money and it's just terrible. And it's like, okay, well, let's slow down a bit. Let me ask you a question. How much money are you losing? And then they tell me, I go, what's the value of your portfolio? And they tell me that, and they're like down 1%, whatever it is, right? That's volatility. That's not losing money. So it's important to keep a good perspective on this. And so this article I wrote today on the website is talking about Star Trek and fighting the Borg. And the thing about, this idea that, there was this line in Star Trek called resistance is futile. And that's what we're talking about here in the financial markets, is that when markets start to rally, we start thinking that, well, it's just going to go up forever now, right? It's like, oh, the correction's over and we're just going to go up forever now and we're never going to correct again. And we start extrapolating these things out into long-term analysis. And look, and there's some very positive things that are going on in the markets. Don't get me wrong, okay? When you have a 19% correction in the market like we did, and you get deviated below the 50-day moving average like we did, you look forward over the next 12 months. Historically speaking, whenever we've had this type of structure in the markets, 12 months forward, 100% of the time, markets have a positive return. But you got to be careful with that. Yes, markets are higher 12 months later from where they are. But again, all that means is that that was just the low point in the market. It doesn't mean that you got all your money back plus more and it was the start of a new bull market, whatever it was. All that has to mean is that if the market's 1 point higher 12 months from now, it was higher, right? But what happened in between here and there? And this is the important thing we have to remember right now. From a bullish perspective, if you just bought the market today and put it away and didn't look at it for 12 months, you will probably, the odds are in your favor that the markets will be higher 12 months from now than they are today. It's not guaranteed. But statistically, it happens. But what about a week from now? What about a month from now? What about 2 months from now? What about 3 months from now? When markets have a big correction and then they rally back, you get to resistance levels, which is where we are now, which is the 200-day and the 100-day moving average is sitting right above the markets where we are right now. You're probably going to have some give back in the markets. Now, does that mean you're going to retest lows? Maybe. I would suggest probably not in this case, unless we actually start seeing some recessionary data. If we start seeing some real recessionary data show up, yes, markets are going to probably retest some lows. But there's a very good probability that this year we've already seen the lows for this year. Doesn't mean that's not guaranteed, right? We may be right back here a month from now talking about new lows in the market. It's certainly possible. And all of a sudden we get a rash of recessionary data. And, one of the risks right now into the markets is that this market recovery gives President Trump some breathing room to be more stubborn about tariff negotiations. And just like he announced over the weekend, he's now going to put 100% tariffs on movies made outside of the U.S. I'm really not opposed to that, by the way, because the movies that we've been making lately, Disney, suck. So let's encourage movie makers to make movies here that are better. I think we should have 100% tariffs on movies that are made outside of the U.S. and 100% tariff on any movie made by Disney that sucks. And let's encourage the people to make some good movies. I mean, Disney, hear me. You already screwed up the Avengers. The whole Marvel universe, you completely screwed that up. So stop. 100% tariff on you. Everything you do with the Marvels from now on, okay?
We need more Westerns.
I don't care what you make. Just make good ones. I mean,
yeah.
Let's not talk about Alec Baldwin and Rust, okay?
No.
Okay.
That aside.
Yes, we need better war movies, better westerns, better rom-coms. Let's because you can't just exclude the women from the conversation. They need the rom-coms.
Yeah.
Right? So you just can't exclude it. But we need good ones. I mean, Hallmark, you need a new formula. It can't be the same. It can't be the same girl that goes to some small town and meets the baker and they fall in love in some high school, fling, right? You need a new theme. But yes, we need more tariffs on movies made domestically, for sure. No, domestically. They don't make good movies. Tariff them too.
Tariff the bad ones.
Tariff the bad ones.
Yes.
Yeah. Encourage good movie making.
Whatever happened to the cartoons before the movies?
Okay, now you're really showing your age. They haven't had cartoons before movies since World War II.
But they were great.
Yeah. It wasn't World War II. It was
Korea.
Last time, pretty close. So let's see. We had Vietnam. There were cartoons before movies and during Vietnam.
Mm-hmm.
We had cartoons before movies in the early 70s. And I think that was about it.
That's about it.
I think they left after that.
And then you had the singing popcorn box, Let's Go Out to the Lobby. That took its place.
Yeah, that took its place. And then, that's not entirely true because then Pixar brought it back temporarily.
Yeah.
They had little Pixar clips like before Ice Age and stuff.
Yes.
So they brought that back temporarily, but then that faded.
That doesn't really count.
No. So anyway, I digress. Back to what we're talking about.
Sorry about that.
It's all right. But the issue is that the recovery in the market now gives Trump the ability to be more hawkish in terms of tariffs, which could put more pressure on the markets near term. I mean, part of this relief rally was this idea that tariffs were reset to 10% and, China is going to bend a knee here. All of a sudden with the market recovering, Trump can afford to be tougher with China than he was before. Right. So this whole kind of pause for 90 days on tariffs that gave the market some relief. He now has that ability to say, okay, well, 90 days is up, tariffs are back. And, we could be back in the same soup. So again, the point is that we're not out of the woods yet. And so we've had this very nice rally back to these resistance levels. And there's certainly some risk looking forward here to markets near term. So again, a retest of some sort of support, and then there's multiple levels of support where we are. You got the 50-day just below where markets closed on Friday. You've got the support level that occurred right before the inauguration or the Liberation Day announcement of tariffs. Then you got the 20-day moving average below that, and then you have the lows. So you've got 4 levels of support between where we are and down those. So again, a retracement here is very likely. So again, we want to use that as an opportunity to buy stuff when we start retracing this rally, and we will at some point. But the question is do we do it from here, or does this market just go, kind of go further? We have 1 or 2 day decline, the market takes off running again. It's possible, but you're going to have another 3, 4, 5% correction, most likely, at some point this summer. I suspect that we won't actually bottom this market until probably sometime August, September, October. It's just, that's just kind of how markets tend to work through correction cycles. There are some exceptions to that rule. A good example of this was in 2023, the summer. We had a grinding 3-month correction during the summer of 2023. And I have this analysis in today's blog post. But we grinded lower for 3 months in the summer of 23, down 10% peak to trough. Market bottomed in October and then took off running. We had very similar levels of negative investor sentiment, negative positioning as we do today. So there are exceptions to the rule, and that we never had a retest of lows that just took off running after that and we ran to new highs. Could certainly be the case here. Historically speaking, that tends to be the exception, not the rule. So again, that's why we want to be a little bit cautious here. Again, raise some cash, rebalance risk, those type of things. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I got an interesting email over the weekend, and I get these emails quite a bit, and I can always tell when I respond to the emails that they didn't like the answer because I don't get a response back, and which means they completely ignored the information I gave them relative to their situation. But I see these emails a lot, and I just saw an article like on MarketWatch. They have people that email questions in about it's a section called the moneyest, and people email in, it's like, hey, I'm 59 and I want to retire in 5 years, what do I need to do? And the advice is pretty generic that gets back. It's like, well, if you have so much money saved up, then you could do this and this, and with Social Security, you can retire, etc. But it's interesting because I get these questions from individuals that are looking for this magic wand, right? This magic solution that is going to bail them out of the financial trouble. And it's like, I just saw this article. It's like, I'm 59. I've got $69,000 in credit card debt. I want to retire in 5 years. Well, so first thing you got to do is pay off $69,000 worth of credit card debt. And then this is the advice that I give people on a regular basis is that, look, regardless of your age, you can't invest and grow wealth if all your money is going to paying off debt. So the first thing you have to do is pay off your debt. And so, I'll get emails from you. It's like, I have $110,000 saved up in the bank. I need you to invest it and grow it so I can retire. Nothing I can do for you. Because all investing is keeping your savings growing at the rate of inflation over time. That's all investing is. You can't take $100,000 and magically turn it into $1 million in 5 years. It's just not going to happen, right? It's just, you've got to take on two. And again, nobody has a magic wand. Nobody has a magic recipe. If you take a long-term look at our track record in terms of our portfolios, we grow portfolios on average 6, 7, 8% a year, depending on the model. And that's to keep track with, investment goals and where you need to be. And that's basically what the market returns over time. Some years we have better years. Sometimes we have worse years. Our goal is to avoid downturns as much as possible. But on average, you're cranking out what the market's going to crank out, 6, 7, 8% a year. So, the thing is that, you have to create cash flow for yourself. And this is the hardest concept for people to really wrap their heads around, because they're living their life, they're doing all these things, they're, and we're all told, right? Oh, you got to have a credit card for this. You've got to have a credit card for that. If you don't have a credit card, you can't have a credit card. It's a complete lie. But this is what the financial system foist upon us for their benefit, right? Because that's how they make money. And we're the consumer. There's an interesting show on either Apple TV or Amazon Prime. I can't remember. But this guy's on the run from the NSA. And they never tell you in the whole first season why he's on the run from the government. But he's on the run with his family from the government. But his whole thesis is that you need to be self-sufficient because the whole system in America is rigged. It's all based on consumerism. And he's right about that. Right? The whole economy is based upon you going out and spending all the money you make to drive the economy. And that's why everything is pushed on you to buy stuff. Social media, full of ads, right? No matter what it is, Facebook, TikTok, whatever. It's just ad after ad after ad, promoting some product. I mean, look, we've created a whole new system of advertising in the last few years called influencers. And so if you can generate any type of following on social media, then you can start pushing product for some company and they will pay that person money for every click, view, sell, whatever occurs. And they can make a whole living just selling products for other people, but it's all based on this idea of consumerism. So the whole idea is to get you to spend all the money you make, go into debt to even consume more stuff, and then you're turning around going, okay, well, how to retire? You can't. you can't. You're going to have to work until you die. It's called the DEAD plan, die at desk. But that's the way the system is built. So if you want to break that cycle, the first thing you've got to do is pay off all your debt and stop using debt. But Lance, I need something and I can't afford it right now. Then don't buy it. That's the hard part. See, this is the hard part about saving and investing and growing wealth, is that you're going to have to learn to sacrifice. And pay for stuff in cash and do those type of things. So, kind of the first step is people email me up and they'll say, oh, I've got $100,000 to, I want to give you to invest for me. No, I want you to take the $100,000. I want you to pay off the $69,000 in credit card debt. I want you to put the other, $31,000 into a savings account at the bank. I don't care if it pays zero interest or not, but $31,000 over there, that's your emergency fund. Never touch it. That's in case something goes terribly wrong. That way you don't lose your house. You get laid off from your job, whatever it is. But now I don't have any money to invest. That's right. But you don't. But now what you have is cash flow. So every month we're going to start putting the maximum amount we can put into your 401k plan, $1,850 a month. But I won't have any money left to live on. Well, that's okay. You'll have to figure it out. But see, this is the hard part. But now they're saving money. Now they're investing the money, right? Now it can grow. Now they can start building some actual net worth for themselves. But see, we don't want to do that because that's not the quick, easy route. And we have to sacrifice our lifestyle, our consumerism, right? We have to sacrifice that to grow wealth. But it's a choice. You can either, Dave Ramsey is great about debt counseling and those type of things. He's a terrible investor, but he's a great debt counselor. He says, and one of his famous lines is that you have to live like nobody else today so you can live like nobody else tomorrow. And that's a true statement. But see, we don't want to do that. We don't want to sacrifice today. We keep hoping that the markets are going to bail us out. We're all going to be fine. But history shows that that's not true. That's not the way it works. Because if it was true, if the markets bailed out all of the financial missteps that people make. Why is it that 80% of people in the country live paycheck to paycheck? 90% of the people have less than a year's salary saved up, right? If the market was such a wealth-generating machine, why do we have these statistics? Why is it that the average 401k plan is about $70,000 in total? Sure, there's some 401k plans out there. Fidelity puts out a report every year that says, we have a record number of millionaires in 401k plans. Okay, take the total number of 401k plans that Fidelity manages, look at all the ones that are over $1 million, it's about 1%. What about the other 90? They're about 1 year's worth of salary, give or take. So we're always looking for the easy solution. There is no easy button for growing wealth and retiring and having money saved up. It's hard work and it's slow and you've got to be patient and you can't take big risk because when you take big risk, the downside's not great. And if you destroy a bunch of your investment capital by taking big risk on the upside and you lose, which happens more often than not, then you've got to start all over again. And the one thing you cannot, this is the most important thing that people forget about investing. I can destroy capital and I can get it back, given enough time, right? Markets always recover losses, always. So far, last 150 years. But there's one commodity I can never get more of, and that's time. And this is the one thing that we don't pay enough attention to when it comes to investing is the value of time. Because we can't make more of it. We can't get more of it. They don't magically hand it out anywhere. We can't buy more of it. We can't invest for more of it. So if I destroy 4 or 5 years worth of growth by taking on a bunch of excessively risky bets in my portfolio that go wrong, and again, we go back to 2022 as a good example of this. People investing in the ARK fund by Cathie Wood. That fund is yet to recover. But all that money that got destroyed, that fund was down 70, 80% from the peak. It's been 5 years since 2020. It's been 3 years since 2022. But that's 5 years or 3 years, depending on where you were, that you're never getting back. And remember, when it comes to talking about these average rates of return, right? You look at a financial plan that you kind of get off the shelf somewhere. It says, oh, plug in your annual expected rate of return. So I plug in 6%. That's great. But if I have a year where my return is 0, I'm now 6% behind my goal. If I have a year where the market's down 6%, I'm now 12% behind my goal. Now, if the market recovers the next year and I get back to even, I'm still down 12% because I've lost 2 years of 6% returns that I needed to reach my goal. So again, this is one of the big fallacies of the financial planning, investing community, which is, oh yeah, markets always get back to even. They do. But if you go through a period of 2 or 3 or 4 years where you're not making the 6% annual rate of return that you need to reach retirement, that 6% is compounding every single year. So you're 24%. If it takes you 4 years to get back to goal, you're behind 24% on that. If you're, right? So just pay attention to the value of money and time, because time is the most critical component and the most valuable asset that we have. All right, have a great day. Wrap up the show. Be back tomorrow with John Penn. See you then.